Hi, everyone. Welcome back to another session on strategic financial management. So we did session 8, financial ratios. I gave you a brief introduction last week to financial ratios. Let's go through that. So financial ratios, I told you what financial ratios are. And I told financial ratios, these are used to compare the performance of the business with the past year. And it is also an effective way of measuring the performance of the business. And it is easy to calculate because you have the formulas that is given to you. You just need to substitute the numbers to the formulas. You just have to take the data from the annual reports, and the annual reports are easily available on the company website, or you can also get them from the stock exchange. So whatever that is convenient to you. So you have the data, you have the formula, you just have to substitute the numbers into the formulas and then calculate to get the answer. Yeah, so this is into financial ratios. That's the reason we say that it is very easy to calculate and it is quick because everything is, you don't have to find it. Yeah, everything is there for you and you can use the Excel sheet to do the calculation. So it's pretty much easy. But what's difficult or what's going to be challenging for you is the analysis and the interpretation part. So you need to be thorough with the analysis, meaning you have to be thorough with, okay, if this is the result, okay, this is what we have to analyze, which I'll be discussing today. And we also look into the importance of financial ratios. Yes, there's more importances for financial ratios, but I just focus only in 4 areas, which is a standardized method of comparison. And it is used for industry analysis and benchmark, stock valuation for strength and weaknesses, planning and performance. Then we went through the 5 types of ratios, which is liquidity ratios, efficiency ratios, profitability, debt management, and investors. I'm just going to go through the definitions here. So liquidity ratios, these ratios help the businesses to evaluate the liquidity position of the business. So here you're going to find out whether sufficient resources are available to meet the liabilities. And here liquidity ratios are mostly focused on short-term debt obligations. And then efficiency ratios. Now this measures how effectively the resources are being used by the organization. And profitability, obviously, it is to measure the financial wealth of the business. Debt management ratios, this measures the relationship between the owner's wealth and the cash contributed by the other parties in the form of a loan. And investors' ratios, these ratios provide necessary information to the investors of the company. It calculates the returns and the performance of the business. And then we went through the limitations of financial resources. Sorry. We went through the limitations of financial ratios. We said we're using historical information. So you know that we use the annual reports. So the results that has already happened. So we used historical information, which may not consider certain aspects of the other financial. Thanks. Next, inflationary effects are ignored. Yes, the inflationary effects are not taken into consideration when we're calculating financial ratios, which is actually, it's pretty much difficult to, sort of rely on the results of the financial ratios because the inflation effects are not taken into consideration, right? Changes in accounting policies, and yes, of course, the manipulation of financial statements. As I told you, we use a term in accounting, we use the term window dressing, meaning you manipulate the financial statements. So organization can actually do that. So they're able to manipulate, they will adjust the numbers, right, in their financial statements in a way that when we calculate the financial ratios, the results of the financial ratios will be favorable to the organization. So the manipulation of the financial statements can be done. And that's the reason always the organization has to get their financial statements approved or proofread by a third party, right? Third party auditor. Okay, so that's about last week's session, and we shall start today's session, which is financial ratios. So session 9, financial ratios, we are going to learn the formulas under financial ratios. We're going to learn the formulas under financial ratios. So the first ratio type that we learned are liquidity ratios. right? So liquidity ratios, now the purpose of this liquidity ratio is to find out whether the company has the capacity to pay its short-term debts. Whether the company has the capacity to pay its short-term debts. And that is why we calculate, sorry, we calculate, give me a minute, please. Sorry, not feeling well. Right, so liquidity ratios, sorry. So this is where the company is going to find out whether they have the capacity to pay its short-term debt. So under liquidity ratios, we'll be learning current asset ratio, asset test, also known as quick asset ratio. So these are the two main ratios that we'll be learning. Yes, there is more, right? There is more. There's something called the cash ratio, which I'll not be teaching for this particular lesson, but there is one more, or there are a few more liquidity ratios that is calculated under this section, but these two are enough. So when you're calculating, or when you're doing your assignment, which is task 1, you need to find, or you need to calculate all the ratios that is covered in this particular module. Right? I see a lot of assignments, not just one or two, many assignments, many students, they don't calculate all the formulas. They don't calculate all the financial ratios. They calculate profitability, efficiency, liquidity, done. What about the other two? Debt management, investors. You need to calculate everything, right? So all the formulas that I have given in this particular slide, you need to calculate the financial ratios for your task 1. Okay? If not, I'll be, you'll have to amend, keep on amending until I approve your assignment. So make sure that you calculate the financial ratios for all the formulas that is here in this particular slide. That this is the minimum expectations. Of course, obviously, of course, you can calculate more ratios, that's up to you, but minimum expectations, I need you to calculate all the ratios that is covered in this particular module. All right. So the first ratio that we're looking into is current asset ratio. So current asset ratio equals to current asset divided by current liabilities. Current asset divided by current liability. So current asset ratio, it is, they're given another term, and it is also known as working capital ratio. Now, this ratio analyzes the capability of the company to meet its short-term liabilities. So current ratio between 1.5. So when you calculate, right, as you calculate, if you get the result as 1.5 or between 1.5 and 2, this means this ratio is favorable to the company, right? So anything that is in between 1.5 and 2, it is healthy. What if it is less than 1.5 or less than 1? This means that the company is struggling to pay its short-term debts. And you cannot be too high as well. Get me? So more than 2. Say, for an example, the result was 2.5. No, that is also bad. So the ideal ratio is between 1.5 and 2. Too low, bad. Too high, bad. So if it is too low, it means that the company is struggling to pay its short-term debts. If it is too high, meaning if it is more than 2, say, for an example, it is 2.5 or 3, this might indicate that the company is not using their assets. Right? They're not using the assets of the company effectively. So this is current ratio. Next, we have quick asset ratio or asset test ratio. Now here, you are calculating the quick asset ratio. You're removing the inventories. You're removing the inventories. So same formula as the current asset ratio, except that you're removing the inventories from the current assets. So quick asset ratio, current asset minus inventories over current liabilities. So this is the quick asset ratio. So as you can see, asset test ratio is similar to current asset ratio, but excluding the inventories. Excluding the inventories. And this quick ratio is actually a more reliable formula or reliable ratio compared to that of a current ratio, because you can find out how well the company is performing excluding the inventory, right? So acetate ratio, the ideal ratio is 1. If the ratio is below, it means there is a liquidity problem. So if the ratio is less than 1, right? If this is, if it is, if it is less than 1, or if it is 1, it is ideal, okay? And then we have, if it is more than 1, sorry, if it is less than 1, hang on. The ideal ratio is 1. If the ratio is below this, it means there's a liquidity problem with the business. Yes. And if it is more than 1, also it is a problem. Meaning it should not be too high and it should not be too low, right? Same with the current asset ratio. Same with the current asset ratio. The ideal ratio or the favorable ratio is 1.5 and 2, between 1.5 and 2. So if it is less than 1.5, less than 1, it is a problem. If it is more than 2, it is a problem. Same with the asset test ratio. So the ideal ratio is 1, right? The ideal ratio is 1. So if it is more than 1, say for an example, it is 1.3, 1.5, it is good. Meaning it is good liquidity, right? The company is running well without relying on inventory. If it is the opposite, which is less than 1, meaning the company is depending on selling the inventories to meet its obligations, right? I repeat, if it is less than 1, the company is having liquidity issues, meaning they're depending on the inventories to meet its short-term obligations. Why? We removed inventories from this formula. So if the ratio is below 1, it means that the company may be relying on the inventories to meet its short-term obligations. More than 1, good liquidity, because they are performing well without relying on inventory. Clear? Next, we're moving on to profitability ratios. On the profitability ratios, we're going to learn about gross profit margin, operating profit margin, net profit margin, and ROS, right? And ROS. Let's see what gross profit margin is about. Gross profit margin equals to gross profit over sales into 100. Gross profit over sales into 100. I believe I showed you an annual report. Have I shown an annual report to you? The financial statements? Did I? Yes, I did. Okay. So in there, in the income statement, you will be able to find the gross profit, right? Gross profit. So as I said, it's very easy. You just need the annual reports. Just go through it. Just see where the things are. For example, where's gross profit? Where is net profit? Where are revenues? Where are expenses, income? Where are the assets? Where are the current liabilities? Just find out all this information. Take it and substitute. I'll be doing a few questions with you. I'll show you how to do it, how to do the analysis, how to do the interpretation, how to do the calculation. I will teach you. So today I'm just going to go through it. I'm just going to go through the formulas and introduce you to the formulas, but I will be doing the calculations with you in the next few sessions. So gross profit margin indicates the gross margin of the company expressed as a percentage of sales. Higher the gross profit, the better it is, right? Higher the gross profit, the better it is. On an average basis, a rate of more than 30% is considered to be favorable. right? So gross profit margin, if it is high, higher the better. So if it is high, it means the company has good control over the production and pricing. If it is declining, say for an example, the previous year it was 40%, this year it went down to 25%. So this could indicate there is a rise or increase in the production costs of the company. So this is gross profit margin. So this is how you have to do your analysis and interpretation. Once you get your result, you have to say, okay, this could be the reason, or this may be the reason why there is a decline in the gross profit margin. So when you compare two companies, say A and B, A has 30%, B has 20%, you can say A is performing well or performing better than company B because A has this percentage, B has this percentage. And you can say maybe B is having this percentage due to these reasons, right? And you can give suggestions as how to improve, on how to improve their performance. This is how you do the analysis, right? This is how you do the analysis. That's gross profit margin. Next, we have operating profit margin. Operating profit margin equals to operating profit over total revenue into 100. Operating profit over total revenue into 100. So operating profit margin analyzes the company's financial health. As a general thumb rule, the ideal operating profit margin and net profit margin is 20% for a company, whereas 5% is considered to be too low. So 20% favorable, 5% too low. Higher, the better, right? Higher, the better. So all the ratios that is under profitability ratios, higher the ratio, higher the result or higher the percentage, the better it is for the company. The favorable it is for the company. Okay. Next, we're moving on to net profit margin. Net profit margin measures the capability of a company to convert its sales revenue into net profit. The ideal net profit is 20%. Again, higher, the better. Next, we're moving on to ROCE. ROCE means return on capital employed, and this analyzes the return of the business received as a percentage of their investment. Right? This is a ROCE. And the ideal rate for ROCE is 20% and above. 20% and above. So a higher ROCE means the company is using its capital effectively. Okay. Now, here you can see it says PBIT, meaning profit before interest and tax. So you have to take the profit before interest and tax has been calculated to the profit. So that's why it is mentioned PBIT divided by capital employed. Capital employed equals to total assets minus current liabilities into 100 because we are calculating the profitability ratios as a percentage. So this is profitability ratios. And next comes leverage or debt management ratios. Leverage or debt management ratios. The first ratio that we are going to cover here, we're going to cover under this is interest cover ratio. Next, gearing ratio, which is a very important ratio for the companies. And then we have debt to asset ratio. Debt to asset ratio. So first let's look into the interest cover. What is this about? Interest cover ratio shows the amount of profit available in the business to cover up the interest that the company owes. Right? How easily can the organization pay or settle the interest? This is the interest cover ratio. This is the interest cover ratio. The average ratio of interest cover is 1.5, and any ratio above that is good for the company, and any ratio that is below 1.5 is an indication that the business does not have sufficient fund. Right? So interest coverage 1.5. Right? If it is below 1.5, it is risky for the company, meaning they will not be able to cover their interest comfortably or smoothly. More than 1.5, good, right? It's good, which means it indicates that the company has a strong buffer, right? So interest cover, again, PBIT, which is profit before interest and tax divided by interest expense. Clear? Next, gearing ratio. Now, gearing ratio equals to long-term liabilities. You have to be very careful. So you only have to take long-term liabilities into consideration, divided by share capital plus retained earnings plus long-term liabilities into 100. Now, gearing ratio compares the owner's equity with the borrowings of the company, right? With the borrowings of the company. What does that mean? Gearing ratio compares the owner's equity with the borrowings of the company. Okay, so here, when the gearing ratio is more than 30%, when the gearing ratio is more than 30%, it's difficult to borrow loans from bank. And having a ratio that is less than 30% is safe for the business. Is safe for the business. But it is said it is a moderate gearing ratio is between 25% to 35-40%, right? A low gearing ratio, which is less than 30%, 25%, meaning that the company is at low risk, right? So companies finance more by the equity of the business, right? Owner's equity. If the gearing ratio is high, it means that the company is heavily reliant on debt, on external, right? So if the gearing ratio is high, it means that the company is heavily relying on debt. So it's the company has a higher financial risk. If the gearing ratio is lower, the company has low risk because the company is running with the owner's equity. So that's the reason gearing ratio is very important, because usually the banks will not give you loans if your gearing ratio is more than 30%. Right? This is gearing ratio. Next, debt to asset ratio. The debt to asset ratio shows the proportion of overall debt borrowing used by the company relative to its total assets. Relative to its total assets. Debt to asset ratio, right? Debt to asset ratio, or you also call it debt ratio, right? So on average, a debt to asset ratio of less than 0.5% is regarded as favorable. However, a ratio more than 0.6 would suggest that a business is more financially risk, right? So if it is more than 0.5% is the favorable, or I would say the ideal ratio, right? That is the ideal ratio. But if it is less than that, sorry, more than that, the business is facing a high leverage, right? The business is facing a high risk when it comes to debt to asset ratio. Okay. Next, we're moving on to investors ratio. Here we're going to learn about EPS, DPS, and dividend cover. What is EPS? Earnings per share, net profit divided by number of shares issued. Earnings per share shows the relationship between the earnings of the business to the number of shareholders during the time. To the number of shareholders during the time. That is EPS. Earnings per share shows the relationship between the earnings of the business, the revenue, the income of the business, to the number of shareholders during the time, right? So they measure the profitability per share. Profitability per share. A higher EPS indicates that the company has higher level of earnings compared to that of outstanding shares. The more, the better it is, right? If the EPS is higher, it means that the company has strong earnings. It is a good sign. Lower EPS indicates that the company has less earnings compared to outstanding shares. Next, DPS, dividend, number of shares issued. Dividend per share shows the relationship between the annual declared dividends issued by a company for every outstanding share. Higher dividend rate indicates that it's favorable for the investors, therefore potential investors will be leading to buy shares. So same with EPS and DEs, same like the EPS, right? Higher, the favorable, lower, it's not favorable. Next, we're moving on to dividend cover. Dividend cover shows the relationship between the earnings available in the business to cover up the dividends of the shareholders. This is dividend cover. An ideal rate of dividend cover is 2 or more, and a rate lower than 1.5 is not favorable for the company. All right. So this is investors ratio. And then we are finally moving on to efficiency ratio. Let's look into efficiency ratios. Here we're going to learn about stock holding period, creditors payment period, debtors collection period. Yes, of course, there are more formulas, there are more ratios that you can add up to all these categories, but I'm only going through the most important ones, right? So when you're doing your assignment, make sure that you calculate all the ratios that is covered in this particular module, in this particular session. Okay? Don't ignore even one of the formulas. Everything has to be covered. Stock holding period equals to average stock divided by cost of sales into 365 days. Stock holding period measures the number of times the stock of the organization is converted into sales. Right? The shorter stock holding period, the better it is. Meaning, the company is this, that implies that the stock of the business is traded quickly. And the company is efficiently managing the inventories of the organization. Sorry. So, stock holding period, the shorter the results. So, say for an example, company A and B, we have two companies, which is A and B. So, A stock holding period, say 20 days, and B stock holding period is 35 days. So, who's performing better, or who's performing better than the other? Obviously A, because A, the stock holding period is less, meaning this particular company, company A, is selling their stock faster than company B. So this is stock holding period, right? This is stock holding period. Next, we have creditors payment period. This is equal to average creditors divided by credit purchases into 365 days. Creditors payment period ratio can be defined as the number of days taken by the company to pay its suppliers. The longer the period, the better it is for the company, as the management of working capital will be efficient for the company. But you know what happens when you delay the payment to the creditors, right? You have other repercussions. So it is better if there's a longer period, but at the same time, you have to remember there are other disadvantages when you delay the payment to the creditors or suppliers. So the average creditor payment period is 30 days. Next, we have debtors collection period. This ratio calculates the number of days the credit customers take to settle their debts. Again, the average debt collection period is 30 days. If the ratio is higher, it implies that the company is taking too long to collect the debt from the debtors. All right. So if that's the problem, meaning if it is taking too long for the, if it is, how do I say, if the customers is taking too long to pay the debt for your company, you might have short-term debt problems, right? You will be having difficulties, or the organization will have difficulties in settling the debts, short-term debts. Clear? So this is debtors collection period. Let's go through a quick revision of all the formulas that we learned today. So we learned the formulas under 5 categories, which is liquidity ratio. We learned about current asset ratio and quick asset ratio. They're very similar to each other, except that when it comes to asset test or quick asset ratio, it's removing the inventories from the current assets. Under profitability ratios, we learned about gross profit, operating profit, net profit, and ROAS. And leverage debt management, we learned about interest cover, gearing ratio, debt to asset ratio. And investors ratio, we learned about EPS, DPS, dividend cover. And efficiency ratio, we learned about stock holding period, creditors payment period, debtors collection period. Thank you so much for attending the session today. I will see you tomorrow with another session.